Hey everyone, welcome to the KE Report in another daily editorial here on Wednesday, November 19th, chatting with Mike Larson. Mike is the editor-in-chief at Money Show. What I always like to do with Mike is discuss what money shows are focused on because it's a bunch of generalist investors getting together, really following some sort of momentum or seeing what opportunities are out there. Broadly, we have had a great year in almost every asset class, but the last few weeks to up to a month has shown a bit of weakness. Everything now is in a bit of a correction or pause type scenario. So, Mike, just curious, the upcoming shows, I believe you're in Sarasota this upcoming weekend. What's the theme going to be? What are you guys going to be talking about at this money show?
Yeah, thanks, Corey. Glad to have me on the show again. You're right. We're gearing up for the Masters Symposium Sarasota. It's December 1st to 3rd, and we're actually at the Ritz-Carlton this year, a new venue right on the bay. It's pretty nice views, nice place to be. But, it's really about making sense of, at year end, making sense of the 12 months that were, preceded it and looking at new opportunities and, new investments for the 12 months that are about to start. I mean, the end of the year and ahead of a new year is a natural time to look at your portfolio, look at what you own, look at what you probably don't want to own anymore, and look at what you don't own but do want to own in the new year. It's a great time to look back and look ahead. So we're really kind of focused on, summarizing what happened in 2025 and getting ready for 2026. And it's kind of funny. I was writing about the markets in one venue, and you go back to Charles Dickens, and it was the best of times, it was the worst of times. And I don't think he was talking about the stock market this year, but it kind of it would apply, right? I mean, you look back at February and March, and all the into early April and all the sort of tariff-driven Liberation Day liquidation. I mean, things were getting crushed left and right. And then, we flipped the switch, we turned around, and it was off to the races. And the markets didn't look back until really the last month. Big run into October. Now we're in this kind of digestion period where a lot of assets, it's everything from high risk AI stocks to crypto to even to some degree gold is kind of funny. And, for a few weeks there, we're sort of trading along with some of those other risk on assets. All that stuff's been pulling back. And the question is now, is this just sort of letting some of the helium out of the balloon and these things are going to continue to float and levitate and rise as we head into the new year? Or is this the start of something more? The narrative on AI has kind of shifted. You've got, legitimate questions about whether this is a boom or a bubble, whereas, 12 months ago, nobody wanted to hear that stuff. You've got kind of some concerns about what the Fed might do. Are they, after a few cuts, are they getting reluctant to cut any further? Are they going to move in the beginning of December? What about the first half of 26? That's legitimately an open question. And part of it is, frankly, I think the market also is kind of flying a little blind here, right? The government shutdown was the longest ever, and that had some economic implications, and was painful for people who get their paychecks from the government, but they're getting back pay now. Some of the economic data that really for a month and a half Wall Street hasn't had its hands on is now going to be, some of it's going to be released, some of it just won't be released at all. And BLS actually announced today it's not even going to publish the October jobs report. I don't know if that's I saw that headline, and it's like, if that's the case, well, it's an old saying, but it's true. Markets hate uncertainty. And if there's more uncertainty than usual, what do you generally do? You kind of, pull back a little bit. You pull in your horns. You get a little less bullish and less aggressive. You sell down some positions. And I think that's probably what you're seeing in the market here.
Well, Mike, that's a lot to dig into there. Let's maybe dig into that last couple points you're making about what's happened since October. After the sugar rush, we've had the pullback really across the board in most sectors. You brought up a couple interesting threads there to pull on. Is it because the market is now doubting whether we're going to get the upcoming cut from the Fed? Does some of this lagging government data put the Fed in a blind position where they're not really sure how to move forward? And could they use that as a crutch? And then the other thing you brought up was, is there an AI bubble that people are now ready to admit maybe has gotten a little bit too far over its skis? You said that they didn't want to consider that 6 to 12 months ago, but really, this has been kind of frothy the whole time. So what has really changed? Are people going to stop buying the dip, or is this a situation where you're noticing a sea change under the surface? What out of all that stuff you mentioned, what do you think is the most substantive?
Yeah, I think, it's interesting that we just don't have this data. The Fed doesn't have this data. And now, again, like I said today, the BLS said it's not even going to publish an October report. It'll publish the November report December 16th, which is, of course, after the Fed's last meeting of the year, which is December 9th and 10th. So, I think the market's trying to incorporate, okay, maybe the Fed will just use this as an excuse and say, we don't know enough. We're punting. We're just going to sit on our hands into January. Wall Street likes cheap money. And even if it may get cheap money later, it would rather have cheaper money now. And so, the delaying of a cut and just the fact that there is less known about the state of the economy, that creates uncertainty. So I think that's definitely part of what's going on. But I think the bigger issue, really longer term, is the AI boom bubble, tech boom bubble question, because it's really not just AI. I mean, that's what the need or the desire or the estimates of demand for AI are big, but so are the actual dollars and cents going into this industry. I mean, you look at the size of these data centers being built all over the country, you look at the electricity demand, you look at the workers that are building these things, you look at the amount of money that's being spent and invested. You look at, all the sort of tertiary and secondary plays that feed into that investment boom, that's real dollars that are having a real impact on the economy. It's not just kind of like this little corner of the economic or tech world, and so it doesn't really matter to the broader macro picture. In this case, it really is a pretty big deal. So, we don't know if this is a boom or bubble. I mean, we don't know if you want to accept the thesis that it's a bubble. Well, you don't know if it's 1998 or March 2000. You look at the last 2 years of the dot-com bubble, and holy cow, if you got off the train or tried to short, God forbid, tried to short that part of the market too early, you got taken out in a bag. So I think that's really what the question is here. And I think from a longer term perspective, once we get through the end of the year, once some of the data gets released, that's going to be the big story next year. How does this thing unfold? Is the bull argument right? Is the bear argument right? Is it somewhere in between? And if something does sort of, pull back the liquidity and investing in that space, what does it mean for the broader economy? So that I think is probably the biggest story, again, for 2026. Whereas now, between now and year end, it's more people focusing, are we going to get one last run? Are we going to get the Santa Claus rally? Is the Fed going to cut? That's stuff that'll keep the market kind of focused and busy for the next 6 weeks. But for the next year, it's going to be that bigger story, in my opinion.
Mike, I'm totally with you. This AI is all over the news right now, rightfully so, right? This AI build out is contributing something like 80 or 90% to the GDP growth in the US right now. But since everybody's making this comparison to the bubble of early .com, let's say early 2000s, that implosion, I've been reading a lot on this and listening to a lot of podcasts on this, and curious your thoughts on, outside of OpenAI, which is essentially a startup that is really just borrowing money or raising money and spending that money. A lot of this other AI build out is through these large tech companies that are using their current cash flow. These companies have huge margins, they're generating a ton of cash, and they're not taking on debt to build out AI. Does that change your assessment of what a bubble pop could be like in this AI sector, because of the fact of, yes, there are some startups here, but also a lot of the major players, they aren't doing this through debt or equity?
Yeah, I mean, I'm kind of more in the boom camp. I mean, I'm a skeptic by nature, trust me. I mean, you and I have talked for a long time, and when I was at my former firm, I mean, I was shouting from the rooftops about the housing and mortgage fiasco before it popped, and then, after it did, absolutely wrecked the economy, it wrecked the financial markets and so on, because it was so intertwined and interconnected with, the inner workings of the financial industry and the investment industry and the financing, banks and so on. So I think that, that was why the great financial crisis was great, because everything going on in housing and mortgages was so intertwined throughout the system. I think here it's more, it's not being financed, as you pointed out, the same way as things were in the housing and mortgage industry. We're not seeing, an IPO a day like we said, money losing IPO almost every day or twice a day like we saw in 98 and 99. So, it's kind of its own creature. And I'm not as look out below, get under your desk, this thing's going to burst any minute now, as some of the Cassandras out there are saying. But, I'll keep an open mind and I'll keep watching. And frankly, I'll listen to the speakers, that we have in the Money Show roster who are probably plugged in a lot better than I am. I mean, one of the reasons we, whether it's in Sarasota or especially as we're, kind of unveiling things for the Vegas event in February of 26, one of the reasons we're programming and bringing more tech AI specialists to answer these important questions, and people who know the industries that serve the AI boom, whether it's utilities, whether it's energy, things like that. So, we're kind of dedicated to getting to the bottom of this thing for better or for worse for our investors. So I will continue to follow the people that I trust and that, whose work I know is legitimate and based on true on the ground research to kind of keep my finger on the pulse of this thing. But, my best read is, yeah, it's not, this isn't, in my opinion, yet on the sort of the cusp. Like to me, I don't see like a March 2000 moment. I guess is the best way I would sum it up, or for that matter, September 2007 moment when that thing started to come unraveled.
Well, Mike, the other thing that it brings to my mind when we talk about tech and AI in particular was the DeepSeek news that we had this year that kind of torpedoed not just the market in, I think it was early January or February, but it also hit utility companies, that were counting on all that electricity demand. As you mentioned, everything's so intertwined, but it also hit the uranium sector, nuclear power, a lot of collateral damage. Do you think there's something like that could happen in the AI sector where if one area tumbles a little bit, it's going to have that contagion effect?
It really depends how far this thing goes. I mean, as Corey pointed out, more of these investments were to date, mostly today, it's been funded by cash flow, things like that. But now you are seeing more bond offerings, you are seeing more debt being rolled into the financing structure of some of this infrastructure. You are seeing, more financing sources start to get tapped. So that's something you got to keep an eye on, and I think especially when you combine it with some of the other, just easy lending that had been going on and that, you're having these sort of frauds that are popping up and some of the, in the car sector and so on, where you're starting to see losses, pop up more than they did certainly for the previous 12 to 18 months. Those are things you always want to keep an eye on. Again, I don't think we're at that sort of cusp point or tipping point or whatever metaphor you want to use. Again, not akin to what we had in like August, September of 2007 or like what we had in March of 2000 when you were right on the precipice and then it was all downhill from there. But I mean, if the euphoria continues, if the financing continues, if the runaway optimism continues, you're going to reach that point, someday. It's just a question of, as a trader, as an investor, do you want to act too soon, meaning you leave profits on the table, or again, if you're even more aggressive, do you want to short through whatever options or outright shorting or whatever, inverse ETFs, that kind of stuff. Do you want to, plant that flag now and then have it get blown away, run over, whatever, because you got another year or two or three till you do hit that point?
Yeah, good old market timing, right? People love to talk crashes. They also love to talk bull markets too. And right now, it's been a great year, but again, everything's slowed down. Let's move a little bit over to the metals sector because look, we're going to be at that Vegas show. And as we've been talking with you throughout this year, is that some of your investors, your attendees at that show have been asking for metals content. Gold, silver, those are in a corrective phase right now. Just focused on gold and silver. Your takeaway from what we're seeing in terms of kind of a historic run through this year and now a correction that, in all fairness, everybody seemed to be waiting for.
Yeah, I mean, look, gold was getting to the point where it was running up $100 an ounce plus per day. At one point, it was really getting overheated on some of the technical indicators. It was probably the most overheated in years and years. Silver obviously was red hot as well. So I'm not surprised that, we've corrected from that 4,300, 4,400 level to 4,000, 4,100, give or take in gold. We're sort of hanging around 50, $51 in silver. If you look at the last, or if you look at I guess really the gold bull market of the last few years, what have you had? You've had a couple month periods where you've had big run ups. You sort of have a little like intermediate term blow off. You chop sideways for 3 or 4 months, and then the bull market resumes. You need, no matter what the asset is, gold, silver, widgets, I don't care. When you run up too much in the short term and everybody's bulled up, you get technically overbought, and then you tend to see these flushes that don't erase the advances, but do retrace part of it, and then you consolidate. You let some of the air out of the bubble, and then or out of the boom, and then once everybody sort of digested those gains, if the underlying fundamentals still argue for higher prices, you resume that march. And everything I've seen in metals kind of fits that pattern. It's like the run up we had in early 2025, and then we kind of had the April peak, chopped around for a few months, and then what happened? You had the run into October. So as a precious metals bull for some time, I should say, I've been a precious metals bull for some time, and I'm still on that train. I think this is just consolidation. I don't think anybody's talking about a bubble in gold and silver. Like they may be talking about a bubble in AI. And even if, the AI thing bursts tomorrow, what's really the spillover into something like gold and silver? They're two total, even if they traded for a couple of weeks, like they were in the same euphoric phase, the underlying fundamentals of one market are completely different from another. So I would argue that I think, the future still looks bright for precious metals, and we're probably just due for a few months of consolidation here.
Well, Mike, after following the precious metal sector as long as you have, and I know we've been talking to you for years about this, everybody likes to try to pin a reason on why it's going higher. So I don't know if you have any cogent thoughts on what you thought was driving it. We've heard everything from central bank demand to geopolitics. Even the government shutdown was thrown in the mix at one point. But if that was what was making it go higher, is the government reopening what's making it go lower? We hear all the time about the Fed policy and monetary policy, the big debt burden, all these other things. But in a way, it was just trading in sympathy with all the other markets. So do you think there's anything that's a kind of a silver bullet answer here as to what's driving these precious metals markets?
No, I think longer term, it's a lot of those forces you mentioned. It is central bank buying, it's de-dollarization, it's, not just de-dollarization, but getting money out of government obligations in general, not just in the US, but in other heavily indebted countries, people looking for more of a long-term store of value. For a while it was the falling US dollar vis-a-vis foreign currencies, and I think the dollar likely resumes its decline in 2026. So I think that's going to be positive. In the short term, yes, it kind of just became another momentum asset in the in September and early October. So that's why it sold off with other momentum assets. But if you look at the long term trend, gold hasn't really been correlated to some of these other things for a couple of years. It was really more of a few weeks. So I think that ultimately those longer term drivers are still with us. They're going to still be with us. The dysfunction in Washington, it's not just a Washington thing. It's dysfunction in Frankfurt. It's dysfunction in London. It's dysfunction, and I would also argue too, the whole run it hot kind of theory that, governments aren't just dysfunctional. They're not going to let growth, they'll pull the trigger on stimulus and borrowing and spending earlier than they might have in previous eras. And that's been something that's going on again in the US as well as other capitals around the world. So, you have that shift to sort of run it hot, fiscal dominance, trend. I think as Lynn Alden talks about it, those are the kinds of things that ultimately are longer term forces that argue for higher prices for precious metals. So I don't think the big underlying drivers that, drive moves for months or years versus weeks or days are going away, nor do I think that correlation that probably applied for days or weeks will apply for months or years.
Hey, Mike, I'm with you. It seems like we just need to go through a little bit of sideways consolidation for the precious metals and see if that next leg is higher, if it just runs up again like it has over the last few years. Let's also move to cryptos because Bitcoin, boy, oh boy, it's been weak recently. It recently went down to under $90,000 a Bitcoin. As we're chatting, it's right around 88,000 right now. We're hearing less talk, I guess, from the White House. I even heard the SEC has taken any sort of crypto commentary off of their agenda for 2026. What's going on in the crypto space? Is the party over there?
Yeah, I mean, that's what is correlated and tied into what happens in the tech sector, a very tech-y type digital asset, alternative asset that is different from gold. I mean, I think there has always been a much tighter correlation. And again, this spans months, quarters, and years between Bitcoin and the NASDAQ and Bitcoin and other tech stocks and so on, because a lot of these companies are involved in that part of the world in some way. They're invested in it. The companies, the strategies, the digital treasuries and so on type companies, they are tied in and linked for various business reasons and investor class reasons to technology. So it makes a lot more sense to me that if you're going to have a sell-off in AI or tech, that it spills over or is correlated with a sell-off in Bitcoin than it does AI and tech and gold, for example. So I think what you're probably seeing is liquidation in that space. You're seeing a lot of levered players get taken out. Some of the crypto people I've spoken with talked about what happened in October, that, that really nasty liquidation day where I forget how, I think it's like $18 billion or something in and crypto positions got liquidated in less than 24 hours. I think that kind of spooked that sector a lot, and probably what you're seeing, again, this is from smart people that I talk to that know more about the industry than me, suggests that there's some lingering hangover from that, and that might be why you're seeing more selling in some of the more mainstream ways people invest in crypto, ETFs, and so on. So, again, I don't think the whole run is over. I don't think Bitcoin is just a fake thing. I don't think crypto is going away. But I understand the sell-off there, and it's tied to tech more than I do the correlation between gold, silver, and tech or AI. And I think that unless and until something changes the mentality there and, rekindles bullishness and sort of a tech optimism, Bitcoin and crypto is going to struggle. It's interesting. Bloomberg had a story the other day. Like I said, if you step down in the crypto market cap and to a lot of the smaller cryptos, there's an index that they track that's actually all the way back to where it was right after COVID. That the smaller, junkier, riskier altcoins, or if you want to use the impolite term, what coins, which I won't say on air for you, but you look at that stuff, that's all given up everything in the last 5 years. Forget, the struggles that the top tier cryptos and the ones that actually have a use case and a business case like Bitcoin, Ethereum, and so on. Yeah, they've suffered, but you go further down the stack and some of that stuff's just been annihilated.
Yeah, I think that's a good point. We won't use the word you were talking about, but we can maybe say crap coins. So, which is more political, more easy to digest. But yeah, there's a lot of those altcoins that have pulled back way worse than Bitcoin and Ethereum. But there's also the crypto mining stocks, which have been incredibly volatile. There's all the fintech stocks, which are kind of related to build onto that platform. And then there is the whole idea in financial circles to not do the traditional 60-40 anymore, but to look at a 60-20-20, 60% being equities exposure for people, 20% being bonds. The other 20% they're calling alternative assets. And so some people have turned to gold and gold equities, but some people turn to cryptocurrencies. Other people turn to just alternative kind of debasement trade ideas, things that are outside the fiat system. Do you think that the action that we've seen just recently in the cryptoverse kind of shoots a hole in the idea of using it as one of those alternative assets, or does it strengthen it because it seems like it is correlated to the tech sector, not non-correlated?
Yeah, the shift to alts, the alternative investment world, and obviously that's a very wide encompassing term, is real. I mean, a lot of our speakers talk about it. Our attendees want to know about it. The numbers show that a lot more money is rotating into the alts category, which can include, as you said, crypto, precious metals, real estate, tokenized assets, private credit, private equity, all these other things that used to be, accessible only if you were a highly accredited or very wealthy investor. It's now been more democratized and more portfolios are investing in those kinds of assets, which I think is ultimately a good thing and it makes sense, but just like anything, it can be taken too far. But no, I don't think that by and large, if the industry is shifting to a model that your average portfolio allocation, instead of being 60-40, does have that 20 component, and let's call whatever it is, 1, 2, 3% maybe of that is currently in Bitcoin. I don't think it goes to zero because Bitcoin's down 20,000 bucks or whatever it is from its high. I think, some of the people that hadn't yet gotten into it might be scared off. Some of the people that are overly exposed might, sell down their positions. But I think ultimately the march into all alternatives, including to some degree digital assets and crypto, probably doesn't go away as a result of this. I mean, that part of the industry is big enough and embedded enough in the financial world that you're not going to sort of change that march in that direction, even if you have a year of volatility and poor performance. I mean, people didn't, gold, precious metals underperformed for, X number of years in various bear markets. But did that mean people said, I never want to own gold again? No. I mean, gold has a much longer history than crypto assets, but I think crypto assets, digital assets are, going to occupy a space in the alternative world for, I don't know if you want to say forever, but certainly for a long, long time.
Maybe this is getting a bit too granular for you, but what about stable coins? Boy, oh boy, we're hearing a whole lot about stable coins. They seem to have also a purpose of investment, but also moving money around. Is there demand? Is there longevity to the stable coin aspect as well?
Yeah, again, you're probably a little deeper than my specialty or deeper into, the sector than I can speak a lot about, but I do know generally what they do and what their purpose is. And I think, it's another way of facilitating crypto trading, crypto transfer, spending in crypto on various things and so on. So I understand just like you're going to have sort of top tier stable coins that actually get used and grow and are a central part to to the, whole sort of ecosystem, there's going to be some that just go away, that don't get the support, don't ultimately serve a purpose. So I think but the problem is you don't know really how that's going to shake out. That's why there's there's multiple players, there's multiple coins, there's, multiple sponsors. And it's just a matter of how this whole thing, who ultimately ends up as the winner and who ends up sort of going away. And I mean, if you want to look at various booms and new technologies that we've had, I mean, back in the late 1990s, you had companies like Ask Jeeves and InfoSpace and, Yahoo and Google and so on. And now you've basically got Google with a few other hangers on, including Yahoo. So, out of that sort of new ecosystem of internet companies, ultimately you have a few that didn't just survive, but became the dominant leaders. And I think you'll see something similar in crypto and in the stablecoin world as well.
Well, Mike, I think the only market we haven't discussed yet is the bond market. We talked equities, we talked commodities, we talked cryptos. What about the bonds? What kind of themes are you seeing from the speakers at the different Money Show events?
I think there is legitimate questioning going on out there, or starting to go on out there. Again, is the AI stuff spilling over into corporate credit? I mean, a lot, you look at a company like Oracle. What's getting talked about? Oracle is one of the biggest hyperscaler type companies. It's the biggest spenders. Its credit default swap costs have gone up. Its corporate bond spreads have widened because it's borrowing a lot of money and it didn't have as good a balance sheet as some of the other companies to begin with. So, you're seeing some leakage of AI questioning into the corporate or riskier part of the bond market. So that's something that people are looking at. I think, the inflation story to me, I think inflation is settling at a higher level than it was. And it's not, I don't know if we get back to 2%. I don't want to say ever, but probably quite some time. So, I think people are looking at the Fed and saying, yeah, they might be able to cut a little bit more, but this isn't going to be like a back to zero kind of thing. Ultimately, I think it's the inflation story, the government bond questions, those have faded a little bit. And now it's more, hey, what's going on in corporate credit? Is some of the private credit shenanigans going on and some of the fraud that we've seen, is that a symptom of a greater problem? Is it sort of like a tip of the iceberg thing, or is it, just an isolated event or two? So you're seeing a little more concern there, but I think it's still an open question. And even myself, I don't have that same sort of feeling about private credit and the risk going on there that I did in 2006, 2007, where I legitimately thought we had sort of a credit Armageddon heading our way.
All right, there you have it. Mike Larson, editor-in-chief at Money Show. Mike, always great chatting with you. Thanks for sharing some insights on the upcoming Money Show and what you're hearing. And everyone, consider going to that Vegas conference, February 22nd to 25th. Shad and I will both be there, hosting a bit more of a metals component to that conference. And hey, gives you an excuse to go down to Vegas over February. Mike, thank you as always for your time. We'll chat again next month.
You got it. Looking forward to seeing you guys there.